All right, quick check before you scroll. If you care about markets, commodities, or just protecting your purchasing power, you need to hear this. Something just snapped in the global trade system, and silver didn't move because of hype. It moved because the math changed. Minutes after Donald Trump dropped a surprise 25% tariff on South Korea, you could literally watch risk models reprice in real time. Capital shifted, volatility spiked, and silver started behaving like it always does when the system itself starts wobbling. Stay with me, because I'm going to show you why this move matters right now, how to recognize this pattern next time, and why dismissing it as speculation could put you behind the curve. Before I explain what caused this surge, let me slow you down for a second and teach you something most people never really internalize. Silver isn't just a shiny metal people trade on charts. It lives in two worlds at the same time. On one hand, it's a monetary metal. Confidence sensitive, reacting to stress, uncertainty, and policy shocks. On the other hand, it's deeply industrial. It's embedded in electronics, autos, energy systems, medical equipment. So when something hits global trade, silver feels it from both sides at once. Think of it like a bridge that carries both commuter traffic and freight trains. If the structure gets stressed, everything backs up at the same time. That's why silver doesn't whisper in moments like this. It shouts. And here's what that means for you. When you see silver moving violently, it's not random noise. It's telling you something about the underlying system. It's a signal. Most traders look at silver and see volatility. Smart observers look at silver and see what's breaking underneath. So, what does that tell us? It tells us we're not looking at a typical price move. We're looking at a repricing of systemic risk. And if you're watching this now, you're ahead of the narrative that's going to dominate financial media in the next few weeks. Now here's what's actually happening, step by step. Trump announces a sudden 25% tariff on South Korea. That's not a symbolic move. South Korea sits right in the middle of critical supply chains. Autos, semiconductors, pharma components, heavy manufacturing. So, when that tariff lands, the first thing that happens is cost inflation. Inputs get more expensive immediately. Margins compress. Companies hedge. But here's the second layer most people miss. Tariffs don't just change prices, they change trust. They signal that global trade is no longer cooperative. It's leverage-based. And when that signal goes out, capital starts looking for assets that don't depend on smooth global coordination to hold value. So, when the trigger hits, here's the cascade. Manufacturers hedge metals exposure. Why? Because if they're buying silver for electronics or solar panels or medical devices, they now have to lock in costs before tariffs spread or retaliation kicks in. That's immediate physical demand pressure. But at the same time, investors rotate out of trade-dependent risk assets. They are looking at stocks tied to global supply chains and asking, how much margin compression can these companies absorb? And they're not waiting for earnings reports to find out. They're moving now. Meanwhile, currency markets start pricing in fragmentation instead of globalization. The dollar might strengthen against some currencies, weaken against others, but the real story is uncertainty. And what does well in uncertain currency environments? Hard assets, tangible stores of value, things you can hold that don't depend on central bank coordination or trade agreements to maintain purchasing power. Silver, sitting at the intersection of industry and money, absorbs all of that pressure at once. That's why the move feels fast. That's why it feels violent. And here's the part that should make you nervous if you're ignoring it. This wasn't caused by a weak jobs number or a CPI print. Those are cyclical. This was a structural policy shock. Those don't unwind quickly. Even if the tariff gets walked back or modified, the trust variable doesn't reset to zero overnight. Once capital sees that trade policy can shift dramatically on short notice, it prices that risk into everything going forward. You can't unring that bell. But wait, there's more happening here that very few people are talking about. When tariffs hit a country like South Korea, it's not just about Korean exports. It's about what happens next in the chain. Does South Korea retaliate? Do they pivot trade relationships toward China or the EU? Do other countries start hedging their own exposure to sudden U.S. policy shifts? Each of those questions introduces another layer of uncertainty, and silver, because it's both a monetary hedge and an industrial input, captures all of those layers simultaneously. It's pricing in scenarios that equity markets haven't even started modeling yet. If you zoom out, this is the same playbook we've seen before. Every time trade cooperation breaks down sharply, Silver reacts before the broader narrative catches up. In the early 1970s, as the Bretton Woods system cracked and trade realigned, silver surged alongside monetary stress. What happened next? Silver went from around $1.50 in 1971 to nearly $50 by 1980. Now, I'm not saying we're going to see that exact move, but the pattern is identical. A shift from cooperation to leverage, a breakdown in trust, and silver front-running the fear. In the late 2000s, after global supply chains froze during the financial crisis and confidence evaporated, silver didn't move because of hype. It moved because real economic plumbing broke. Banks stopped trusting each other, trade finance dried up, and silver climbed from under $9 in late 2008 to nearly $50 by 2011. Same pattern we're seeing today. The system shows stress, trust erodes, capital repositions. Even during the 2018-2019 trade war cycles, silver consistently front-ran broader market fear. When Trump announced tariffs on China, silver would spike before the equity indices fully priced in the impact. Why? Because industrial users were hedging immediately. They couldn't wait to see how negotiations played out. They had real-world production schedules and cost structures to protect. When you look at the pattern across decades, it's not random. It's responsive. The larger story is this. When trust in the system erodes, assets tied to both production and protection reprice first. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this move fade? Absolutely. Markets overshoot all the time. We could see profit-taking, we could see a technical pullback, we could see consolidation in the mid-90s before any further move. Could there be speculative froth layered on top? Of course. Momentum traders pile in, options activity spikes, social media amplifies the narrative. That's all real. And no, silver doesn't go straight to $135 in a clean line without pullbacks, volatility, or pain. Anyone telling you it's a smooth ride to the moon is lying to you. Could this be manipulation? Could there be hidden players pushing prices around? Maybe. I'm not naive about how markets work, but here's the thing. It doesn't actually matter whether someone's pulling strings behind the scenes. The mechanics are what matter. Focus on what you can control. Focus on whether the underlying stress is increasing or resolving. Right now, the policy direction points toward more leverage, not more cooperation. The fundamentals around supply chains, monetary stress, and industrial demand haven't changed. They've intensified. So, whether you want to call it manipulation or market forces, the data is moving in the same direction. There are probably 3 types of people watching this right now. Maybe you're already in silver and you're wondering if you're late or early. If that's you, I get it. You're sitting on some gains, maybe you bought in the 80s or 90s, and now you're asking yourself, do I take profit? Do I hold? Do I add? Here's what I'll tell you. Your job isn't to predict tops. Nobody rings a bell at the peak. Your job is to understand why you're in the trade and whether the thesis is strengthening. If you bought silver because you thought trade tensions would escalate, tariffs would increase, and monetary stress would build, well, is that happening or not? If it is, your thesis is validating. Manage your position accordingly. Use stops if you need to, but don't exit based on fear of missing the top. Maybe you're skeptical, thinking this is just another headline-driven spike. That's fair. You've seen silver run before and pull back hard. You've watched people get wrecked chasing momentum. I respect that caution. If that's you, here's my advice. Don't watch price. Watch policy. Watch supply chain language. Watch trade rhetoric. Are tariffs expanding or contracting? Are countries retaliating or negotiating? Are industrial users buying aggressively or standing down? The price will follow the fundamentals. If the fundamentals weaken, the skeptics were right. If they strengthen, the skeptics were early. Or maybe you're new, feeling like you missed something important. You didn't. These moves unfold in phases. The first leg catches the early movers. The second leg catches the confirmation crowd. The third leg catches the momentum crowd. We're probably somewhere between phase 1 and phase 2 right now. If you're thinking about exposure, educate yourself first. Understand the asset. Understand the risks. Understand that silver can drop 15% in a week and rally 20% the next. It's not for the faint of heart. But if you believe the structural thesis, if you think trade fragmentation and monetary stress are real, then timing the perfect entry is less important than having the right framework. The universal principle for all of you is the same. Follow the mechanism, not the noise. So here's what I want you to answer in the comments. Where are you in this? Are you holding? Are you watching from the sidelines? Are you adding exposure or taking profit? I'm not asking for financial advice. I'm asking where your head's at. Because the best thing about this community is we learn from each other's perspectives. Drop a comment and let's talk through it. Here's where I stand. I'm not chasing hype, and I'm not fading fundamentals. I'm watching three things closely. First, I'm watching whether additional tariffs or retaliatory measures appear. If South Korea responds with tariffs of their own, or if Trump expands tariffs to other countries, that's a signal that fragmentation is accelerating. If we see de-escalation or negotiation, that's a different signal. Second, I'm watching how industrial users behave. Are they hedging aggressively or standing down? If you start seeing silver premiums spike, if delivery times extend, if physical demand tightens, that tells you real users are locking in supply. That's not speculation, that's genuine demand. Third, I'm monitoring whether currency markets continue to price fragmentation. If we see continued volatility in FX markets, if we see safe haven flows into gold and silver intensify, that validates the monetary side of the thesis. Based on my analysis, this tariff wasn't emotional, it was mechanical. It introduced real costs and real uncertainty into a system that depends on predictable trade flows. And the fundamentals behind silver aren't breaking, they're validating. Supply constraints are real, industrial demand is structural, monetary policy is still loose by historical standards. If history rhymes and silver consolidates above $100 while these tensions build, the move that follows could be significantly larger than what we've seen so far. I'm not making a price prediction, I'm telling you the pattern. The real move doesn't happen when everyone's calm. It happens while people are still arguing about why it moved at all. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Challenge it. Test it against data. Make your own decisions based on your own risk tolerance and financial situation. But if you made it this far, you're the kind of person who wants to understand how things actually work, not just follow headlines. That mentality will serve you well. If this breakdown helped you see something you missed before, hit that share button. Get this in front of people who need to hear it. Subscribe if you want more analysis like this as these situations develop. And stay sharp out there. Think critically, verify data, and always make your own decisions.